An investing philosophy is a set of guiding principles that shape an individual's approach to investing. Choosing an investing philosophy is at the heart of successful investing. All the super investors have an investing philosophy, and they stick to it, and it leads to massive success in most scenarios, such as Warren Buffett, which we will briefly discuss in a little bit. So if you don't know what an investing philosophy is, the types, or especially if you do not have one, you will want to watch this to help you begin building one. This is essential before you start investing, but don't worry if you've been investing for years and don't have one, as you can still create one and implement it to make you a stronger investor and make your portfolio more resilient and protected. Another way you can say investment philosophy is basically your investing style. That sounds a lot cooler to me. But what are the different philosophies and styles? Well, there are really endless philosophies, but let's cover the most popular ones that we know and see. There is value investing, growth investing, dividend growth investing. Then you have technical analysis and fundamental analysis, and those are another pair of investment philosophies. These are the main ones that investors follow, but I will cover a few unique ones at the end and show you how you can really create your own investing style. But I think it's good to stick to the ones that are proven and tested. So let's talk about value investing. That is where the investor focuses on shares that they believe are fundamentally underpriced and trading for less than their intrinsic or book value. Opportunities can arise when the market overreacts, causing stock price movements that do not correspond to a company's long-term fundamentals. Investors seek stocks that the market is underestimating and purchases those stocks at discounted prices. You can think of a TV. It may go on sale due to lower demand as the company tries to boost units sold. Though it's on sale, there's nothing fundamentally wrong or different about that TV versus when it's at full price. But you can get it for much cheaper on sale than when it's on full price, and that's what these investors are trying to target, those companies that are on sale. So value investors use financial analysis, they don't follow the herd, and are long-term investors of quality companies. Now, Warren Buffett is probably the most famous value investor and has practiced a value investment philosophy since studying under legendary value investor Benjamin Graham in the early 1950s. We all know how successful Warren Buffett has been, as he's one of the richest men in the world and has been that way for a long time. Now let's jump to growth investing. This is where investors buy shares of companies that are in a growth or expansion phase that are generating above average sales and earnings growth in hopes of a rising stock price. Growth investors typically look for investments in rapidly expanding industries or even entire markets where new technologies and services are being developed. I think recently we see that with AI. Now, growth investors tend to favor smaller, younger companies poised to expand and increase profitability potential in the future. But we do see it with the big tech companies as well, as they are growing faster than the average market with their revenue and earnings. So it's not always just the small companies, but with the small companies, they are untried and thus often pose a fairly high risk. So growth stocks do trade more in those higher PE ratios as investors' expectations for growth is high. So growth investors often look to 5 key factors when evaluating stocks. They look at historical and future earnings growth, profit margins, return on equity, and share price performance. So with growth in mind, we now jump to a different philosophy, and that's dividend growth investing, which seeks companies that have a long history of paying uninterrupted dividends while raising those dividends year after year, which can also be said as returning profits to the shareholders. These stocks usually produce a higher yield, around 3% or higher. Investors here seek higher and higher dependable passive income. Usually retirees seek the strategy as an added source of income. Investors use the dividend payouts that they receive to reinvest in those companies' shares or shares of other companies with similar dividend track records. The goal is compound investment portfolio growth. Dividend growth investments are generally recognized as low volatility, as they are usually in well-established companies with stable earnings and strong balance sheets. So you're not going to really get the high returns as you would with growth investing, but you have more stable, dependable companies, and people usually value that more than the more riskier growth companies. So now we move on to fundamental analysis. This relies on identifying companies with strong earnings prospects. Investors are interested in evaluating the fundamentals of a company to compare its economic position relative to its industry peers, to the broader market, or to itself over time. Fundamental analysis involves digging deep into a company's financial statements to extract its profits and growth potential, relative riskiness, and to ultimately decide if its shares are under, over, or fairly valued to the market. So now we move to technical analysis, which relies on examination of past market data to uncover hallmark visual patterns in trading activity on which to base buy and sell decisions. Investors seek trading opportunities by analyzing statistical trends gathered from trading activity, such as price movement and volume. Unlike fundamental analysis, which attempts to evaluate a security's value based on business results such as sales and earnings, technical analysis focuses on the study of price and volume. So technical analysts believe past trading activity and price changes of a security can be valuable indicators of the security's future price movements. So now that we move from the main type of the investing styles and philosophies, let's go to lesser known investing philosophies. One is socially responsible investing, which focuses on investing in companies whose practices align with an investor's values as they pertain to the company's impact on society and environment. Now, it's also known as ESG investing, or environmental, social, and governance. So what I will say here, if you choose a path like this, you have to be aware that typically investing goes for profits, right? You want to maximize your returns. But if you go towards something where it's more of a value that you hold as far as, the lowering the impact on society and the environment, or impacting them in positive ways, you probably won't have as high of returns as you would with growth investing or the other type of philosophies that we covered. That doesn't mean you aren't going to choose companies that are responsible in these areas that have good earnings and stuff, but you have to know that you might have company A and company B. This is the socially responsible, environment friendly one. This one isn't as friendly, but maybe its earnings are growing twice as much and as well as its revenue, but you're still going to choose this one. And that's my point. So you could probably choose a path that would grow your money more, but if the values of the impact on society and the environment are more meaningful to you and something that you are going to focus on, just know that the returns might not be as high as the other philosophies that people practice. But I do respect that, and I do think that's something, though, that you need to consider the long-term goal of the returns that you want to make versus, hey, because I have this feeling here and this is what I want to invest in. Make sure you just weigh that out, because once you get to retirement, are you going to be happy with the decision you made? The next type of lesser known investing philosophy is contrarian investing, and as the name implies, it goes in the opposite direction of the crowd. So swimming against the current, these investors assume the market is usually wrong at both the extreme lows and highs, selling into rallies and buying when markets tumble. I don't know if you guys follow a lot of other YouTube financial channels, but there's one, the Joseph Carlson Show, and he has what's called the dip finder with his investments. He has his own software he uses, but that's kind of similar, where he sees the past so many trading days, what stocks are going up or trading down, and he focuses on buying those that trade down. So you can do something similar where it's not as extreme as just going against the market in general. You can go just with the stocks that you hold and that you believe in and that you found, and kind of buy that way. So I think the moral of this is you can have bits and pieces of all these strategies to build your own, which leads me to, what type of investor am I? I'd say I'm a mix. I'm relatively young, so I feel I can take on a little more risk. Therefore, I'd say I'm 75% growth investor and 25% value investor. I started out a dividend growth investor, but as I educated myself more over the years, I pivoted away from that, as I feel that would be too safe and cause me to miss out on a lot of gains over the next few decades. So now I focus on quality companies with those strategies, which helps ensure I am buying companies that have a higher probability of success and growth. This helps support a portfolio that sees overall continuous gains. Now, how do I go about this? Well, I created this quality checklist, and I show it often on this channel. And when I do find a growth or value stock, it has to check all these boxes for me to buy it. And that helps ensure me that this company is healthy enough, it has a wide moat, it's got a good future. that it's very unlikely that I would see losses in this company long term. So I usually buy it, but I obviously do a lot of analysis and research on it first. So that leads me to this, my portfolio. I am up over 19, almost 19.5%. And you'll see the mix here of all my different strategies that I've done over the years. So I have the growth investing, which I believe is Microsoft and Amazon. Those companies are growing faster than the general market. Health Equity is my newest stock. It's a smaller company and one that I'm betting that it will grow at a faster rate than the general market as well. Then I have my value plays. So you'll see Vici. I believe this company's at a great value right now due to the market with the high rates. It's really suppressing these REITs. This is a high quality company. So I really believe this is at an excellent value right now. S&P Global to me as well hasn't performed that great. I think when I first got into this, I saw a good value company. It does have also growth with it. So a lot of these companies will have a mixture of things. Now, when I went into dividend growth investing, when I first started investing, you'll see companies like Cisco, Johnson & Johnson, AT&T, and 3M, and those really are collectively my worst performing stocks. I've held these the longest, and they've literally been duds or have lost me pretty decent money. Warner Bros. Discovery, I got that from AT&T, so I didn't buy that stock. It just spun off. But kind of shows to me a picture, right? The dividend growth stocks that I went for didn't turn out well for me. The growth stocks have done the best, and the value stocks have done fairly well. Now, of course, over time, we'll see things maybe change. Maybe growth stocks are the ones that have really benefited over the last few years since the pandemic. You'll also see Union Pacific. To me, that's also a value play. So regardless of where I've been in time, I've had different strategies, different philosophies, and I adapt, I learn, I grow. And that's what I want you guys to know is that you're not in this box. You don't have to stick to just one. You can implement different philosophies, but you have to come up with one. You have to put maybe how much percentage you want towards growth, how much percentage you want going to dividend growth or value, and stick to it. So what type of investing philosophy do you follow? A lot depends on your age, your risk appetite, your goals, your values, and more. It is up to you to create your investing style so that you stay on track and create the best outcome possible with your long-term investments. Growing our wealth is essential for increased financial freedom and stability. None of this is required, but without a strategy and investing style, you're likely to be at a higher risk of losses or even stop investing altogether because you have no real path. I think of it as working out and trying to get into shape and reaching your goals. If you go to a gym and you have no plans on what you're going to do, you're going to be very confused. It's going to be harder to reach your goals. But if you hire a personal trainer, which I will say in this example, we'll say to compare it to financially, the investing side of things, the personal trainer is the philosophy, right? We go to this trainer, we say, here's our goals. I want to build muscle, or I want to lose weight, or I want to just get really toned. They'll be able to help you based on their strategy and knowledge, build you something to a workout plan to get you to your goals. The same is with investing with these investment philosophies. You got to choose the ones based on your goals to help you get there. Because if you don't have that foundation, you really are not going to be able to stick to it. It's super hard. So I really hope this video with these investment philosophies and styles and talking about them helps inspire you to either reevaluate the current ones you have or to create your own philosophy, whether it's a mixture or just one, or you think of something new, but make sure you're focused on the success long term, right? Do you want to make a lot of money? Are you more focused on the social, environmental side of things? It all matters, but be sure to create a philosophy so you stick to it and create the success that you want. So with that said, we'll see you guys soon for a lot more content, so be sure to subscribe. Have a great day, happy investing, and thank you for joining today. We'll see you soon on Mark Arnold's Finance.